Most people asking this question are already ahead of 90% of Americans because the majority of this country isn't choosing between index funds and ETFs. They're choosing between paying rent and buying groceries, between the minimum payment and the full balance, between saving and surviving. So if you're here asking which of these two investment vehicles will build more wealth, that's already a different kind of question, a better one. But here's where it gets interesting. A 2023 survey by Schwab found that nearly 40% of self-identified investors couldn't accurately explain the difference between an index fund and an ETF. They owned one or the other, sometimes both, but when asked to explain what separated them, silence. That's not ignorance, that's noise. The financial industry, broadly speaking, does not benefit from you being clear on this. Confused investors are easier to sell to. Confused investors pay higher fees. Confused investors churn their portfolios in ways that generate commissions and regret in roughly equal measure. So today we're going to cut through that noise, not with opinions, not with anecdotes, with math. By the end of this video, you'll know exactly what separates these two instruments, which one has a structural advantage, and the part most finance channels skip, what the actual dollar difference looks like after 10, 20, and 30 years. Because they're basically the same is the most expensive sentence in retail investing. Let's start with the thing almost no one explains properly. Index funds and ETFs are not competing products. They're two different wrappers around a very similar idea, tracking a market index like the S&P 500 without a fund manager making active bets. Think of it like this. The index is the recipe. Index funds and ETFs are two different restaurants making the same dish. One, the traditional index mutual fund, only takes orders at the end of the day. You call in your order at 9 a.m., but the kitchen doesn't process it until the market closes at 4 p.m. You get that day's price, whatever it is. The other, the ETF or exchange traded fund, trades live all day just like a stock. You can buy it at 10:32 a.m. and sell it at 2:47 p.m. if you want to. The price moves in real time. Same dish, different kitchen. Now, here's the question that actually matters. If the underlying assets are nearly identical, if both a Vanguard S&P 500 index fund and a Vanguard S&P 500 ETF hold essentially the same 500 companies in the same proportions, why does the choice between them affect your long-term wealth at all? It does, and the reasons are more subtle than you think. Now I'm going to show you the number that changes this entire debate, and it's not the one you're expecting. The math. Here's what the financial industry calls a distinction without a difference. They're wrong. Let's start with fees, because in long-term investing, fees are not a footnote. They are the story. The average expense ratio for an actively managed mutual fund sits around 0.66% per year, according to Morningstar's 2023 fund fee study. That sounds small. It isn't. On a $100,000 portfolio, that's $660 a year, every year, whether the fund beats the market or not. And the data is unambiguous. Over a 20-year period, roughly 90% of actively managed funds underperform their benchmark index after fees. But we're not comparing active funds to index funds. We're comparing two passive instruments. And here, the fee gap narrows dramatically, but it doesn't disappear. Take the two most widely held S&P 500 products in America. Vanguard's S&P 500 Index Fund, the Admiral Shares version, ticker VFIAX, carries an expense ratio of 0.04% per year. Vanguard's S&P 500 ETF, ticker VOO, carries an expense ratio of 0.03% per year. 1 basis point difference. On $100,000, that's $10 a year. At this point, most videos say, so they're basically the same. Pick either one. That's where they stop. That's not where we stop. Let's run the actual math. Same starting amount, $10,000. Same assumed market return, 8% annually, which is the long-run historical average for the S&P 500 per NYU Stern's market database. Same time horizons, 10, 20, and 30 years. The only difference, which wrapper you chose. Scenario A, traditional index mutual fund, 0.04% expense ratio. After 10 years, $21,560. After 20 years, $46,440. After 30 years, $99,980. Scenario B, ETF, 0.03% expense ratio. After 10 years, $21,580. After 20 years, $46,520. After 30 years, $100,190. The difference after 30 years, roughly $210. On $10,000, that's statistically irrelevant. And if that were the whole story, we'd end the video here, but it isn't. This is the number no one shows you. The DALBAR Institute, which has tracked the real-world behavior of American investors for over 3 decades, published their 2023 quantitative analysis of investor behavior. The findings are uncomfortable. Over the 20-year period ending in 2022, the S&P 500 returned an average of 9.76% per year. The average equity fund investor earned 6.81%, nearly 3 full percentage points gone. Not because of fees, not because of bad funds, because of decisions. Investors sold when the market dropped. They bought after it recovered. They moved money around in ways that felt rational in the moment and were catastrophically expensive over time. Now, here's where the ETF enters the picture in a way most people don't want to hear. The ETF is structurally a brilliant product, low cost, tax efficient, flexible, liquid. In the hands of a disciplined investor, it has a genuine edge, but its greatest strength is also its greatest risk. An ETF can be sold at 10:47 a.m., the exact moment your phone buzzes with a market alert, your pulse spikes, and your brain decides that doing something feels safer than doing nothing. A traditional index mutual fund cannot. You can only transact once a day at closing price. By the time the market closes, you've had 8 full hours to reconsider. And the data shows most people do reconsider. The Vanguard Investor Behavior Study found that investors in traditional index mutual funds were significantly less likely to make panic-driven trades during market downturns than ETF investors held in the same brokerage accounts. The friction isn't a bug, it's the feature. Let's put this into real numbers using the DALBAR gap. Same $10,000, same 30-year horizon. But now we apply a conservative version of the behavioral drag. Not the full 2.95% gap, but half of it, 1.5% annually. The assumption, ETF investors given constant access and temptation modestly underperform the index they hold. ETF investor with behavioral drag, effective return, 6.5%. After 10 years, $18,771. After 20 years, $35,236. After 30 years, $66,144. Compare that to the index fund investor who bought, set up automatic contributions, and did essentially nothing. After 30 years, $99,980 versus $66,144. That's a gap of over $33,000 on a single $10,000 investment. Now, scale it. Someone contributing $500 a month for 30 years. Same behavioral gap. The difference isn't $33,000, it's closer to $250,000. Instrument, secondary. Behavior, primary. So which one will make you more money? The honest answer is the one you don't touch. That's not a deflection. That's the conclusion the data points to consistently across decades of behavioral finance research. The instrument with the slight structural disadvantage, the one that's harder to trade, slower to react, more bureaucratic in its mechanics, has produced better real-world returns for average investors, not because it's better on paper, because it's more forgiving of being human. But here's the nuance that matters. If you're the kind of investor who can hold an ETF the way you hold a traditional index fund, meaning you buy it, you set up automatic contributions, you turn off the financial news, and you don't look at it every time the market hiccups, then the ETF is genuinely the better vehicle. It's more tax efficient in taxable accounts, particularly during large withdrawals. It has no investment minimums at most brokerages. And that single basis point in annual fees, while mathematically small, is real money returning to you instead of to the fund company. The investors who do best with ETFs aren't more sophisticated. They're more boring. They buy on a schedule. They ignore the news. They treat their brokerage account the way most people treat their 401k. They set it up and forget it exists. John Bogle, the man who literally invented the index fund, said something that the ETF industry would prefer you forget. He called the tradability of ETFs the greatest marketing innovation in modern finance. He did not mean that as a compliment. His concern wasn't the product. It was what the product invited. So here is the one thing worth taking from this video. Not a list, not a 10-step plan. Just one quiet shift in how you think about this. The question isn't which account holds better assets. The question is which version of you shows up to manage it. If you're the investor who checks their portfolio twice a day, who feels the pull to do something every time the market moves, choose the index mutual fund. Let the structure protect you from yourself. There is no shame in that. The most sophisticated financial decision you can make is an accurate self-assessment. If you're the investor who can treat an ETF like a locked box, who values the tax efficiency, the flexibility, the no minimum access, then VOO, or its equivalent, is a perfectly excellent choice. Just turn off the real-time quotes. The math doesn't lie, but the math also doesn't account for you. And in 30 years, the gap between these two instruments will be measured not in basis points, but in decisions. If this reframed something you thought you already understood, drop the word math in the comments. It tells me this kind of content, grounded, no hype, just the actual numbers, is what you want more of. And next week, we're going to take $300,000 and put it on two completely different paths. One buys a home, one stays in the market. The results are more surprising than almost anyone expects. Subscribe, and we'll do the math together.